Palladium isn't waking up. It's being repriced under pressure, and the market structure is leaking the truth before the headlines catch up. You're being told this metal is yesterday's story, that EVs made it irrelevant, that the surplus is inevitable, that any rally is just noise. And yet, right now, the price action is behaving like a market that's running out of time, not running out of relevance. That's the conflict. Because if Palladium were truly dead money, it wouldn't claw its way back through a line like $1,800 with this kind of urgency. And here's the part most people miss. The spot price is the loudest number, but it's not always the most honest one. The curve, the spreads, the way the market prices delivery versus time, that's where the real pressure starts. Over the last stretch, we've watched Palladium go from looking sleepy in the mid-1600s to printing into the low 1800s, with recent trade poking up toward the high 1800s. That kind of move is not a meme. It's a signal. It's the market pulling a risk premium forward. But that's not the part that matters. The part that matters is what $1,800 does to behavior, because old $800 is not just a number on a chart. It's a switch. It's the level that changes how hedgers defend, how shorts breathe, how dealers manage options exposure, how industrial buyers decide whether they can wait one more week. And when you get a switch like that in a thin liquidity window, the math gets violent. This is why the mainstream will always be late. They need a clean narrative, but markets move on mechanisms. The mechanism in Palladium is simple to say and hard to live through. It's a small market with concentrated supply, a demand base that doesn't disappear overnight, and a curve that can flip from plenty of time to pay up now, faster than your emotions can catch up. And that's where the three conflicts enter the room, not as clickbait, but as a stress test. Taiwan Strait tension, the Korean Peninsula's event risk drumbeat, and the Arctic turning into an open security argument. Those aren't three separate dramas. There are three ways the world tells every procurement desk the same thing. The cost of being wrong is rising. And when the cost of being wrong rises, inventories stop being inefficient and start being insurance. That's why this can explode toward $1,800 and beyond, even while people argue about fundamentals. Because the fundamentals are not just consumption and production, the fundamentals are also timing, logistics, financing, and fear. And the market prices fear in the front months first. If you've been around commodities long enough, you know the feeling. It's not that supply vanishes, it's that the timeline collapses. The metal you could have had in 30 days suddenly isn't good enough. The metal you could have rolled smoothly becomes a scramble. And in a metal like Palladium, that scramble doesn't need huge tonnage to move price. It just needs the marginal unit to go missing at the wrong moment. Because if this one level breaks, the math changes. Let's ground this in what you can actually watch, not what you can argue about. First, the chart structure. Palladium has been rebuilding from a long bruising period where every rally got sold, because the story was substitution and EVs and structural decline. But markets don't reward stories, they reward positioning, and positioning loves certainty right up until it doesn't. When price pushes through a widely watched level like $800 and holds it, you get something that's more powerful than bullish sentiment. You get trapped belief. You get late sellers who suddenly need liquidity. You get hedgers who must decide whether their protection is still protection. You get volatility sellers rethinking their calm assumptions. And you get dealers managing options risk in a way that can create reflexive buying into strength. That's not conspiracy. That's plumbing. Dealers don't pick a side because they love a metal. They pick a side because their book forces them to. If calls get bought and price climbs into a strike-heavy zone, dealers hedge by buying the underlying. That buying lifts price, which increases delta, which forces more hedging. That's reflexivity, the market feeding itself through risk management. And Palladium, being thin, can feel that feedback loop like a microphone too close to a speaker. But here's the next detail that flips the whole setup, the curve. In commodities, the futures curve is the market's heartbeat. Contango means pay me to hold it. Backwardation means pay me to deliver it now. When the front end tightens, even if the long end still looks comfortable, it's like a body running a fever. Something is happening in the near term. And Palladium has lived through periods where analysts point to deficits while the curve stays in contango, implying above-ground stocks are cushioning the blow. That's a critical nuance. It's why lazy deficit equals moon takes get people hurt. But it's also why a shift at the front end matters so much. If the market has been leaning on above-ground stocks, the curve will tell you when that cushion is being leaned on harder, when the convenience yield rises, when nearby demand gets urgent. You don't need to predict the entire decade. You just need to recognize when the market's calendar is forcing hands this week. And we are in exactly that kind of window. Earlier liquidity can be thinner than people admit. Positions are being rebuilt. Books are being reset, and the market is extremely sensitive to headlines that change risk assumptions over a weekend. That's why you see these sharp moves, these gaps, these sudden, where did that come from? But big moments. They come from the calendar. They come from the roll. They come from who needs to be flat, who needs to be hedged, and who can't afford to be short optionality when geopolitics is humming. But don't take my word for it. Watch what tight markets always reveal: the behavior of buyers. Industrial buyers don't chase because they're excited. They chase because waiting becomes more expensive than paying up. When shipping risk rises, when insurance risk rises, when lead times become uncertain, procurement managers don't say, well, the 3-year thesis is bearish, so we'll just gamble our production line. They say, what is the cost of a shutdown? And that's where Palladium's personality shows up, because Palladium is not a cute hedge. It's a necessary input for specific applications, most famously catalytic converters. And demand doesn't disappear just because a narrative is popular. It shifts, it substitutes, it responds, but it does not teleport. And the substitution story, palladium swapped with platinum in some autocatalyst formulations, is real, but it's not frictionless. It requires engineering decisions, certification timelines, supply availability of the substitute, and a willingness to change in the middle of a complex manufacturing chain. Even if the long-run trend is toward less palladium per vehicle, the near-term reality still matters. And there's a messy detail the clean bear narrative hates: hybrids. Hybrids and internal combustion production don't vanish overnight. And emission standards don't take a year off because a technology roadmap looks inevitable on a slide deck. Demand can soften and still be tight at the margin if supply can't flex. And palladium supply can't flex the way people assume. This is a byproduct heavy metal. It's tied to mining economics that are not driven purely by palladium price. If the primary metal's economics don't justify ramping, palladium doesn't magically appear because you want it. Add in operational constraints, power reliability, labor disruptions, processing constraints, and you get a supply chain that is not responsive. It's sticky. And sticky supply in a small market is how you get outsized price moves. But that's still not the hidden detail. The hidden detail is the surplus story, the one you all hear repeated like gospel. Palladium is going into surplus. Listen carefully to how that claim is built. Much of the projected transition to surplus depends on recycling growth arriving on schedule. Not maybe a bit more recycling, but a significant ramp. That's a huge hinge, because recycling is not a dial you turn with a button. Recycling depends on end-of-life vehicle flows, scrap collection, processing capacity, and the willingness of holders to part with material at current prices. It depends on logistics and refiner throughput. It depends on time. And when analysts say surplus, what they often mean is surplus if the recycling ramp happens cleanly. If it doesn't, deficits can persist. And in a market like palladium, persisting deficit doesn't just mean tight. It means fragile, and fragility is what triggers price spikes. You can feel the market wrestle with this, because if everyone truly believed surplus was imminent and certain, $800 would be a ceiling, not a floor fight. So what's the force trying to suppress the move? It's not a villain twirling a mustache. It's incentives, funds that have been trained to fade rallies in palladium because that trade worked for a long time. Industrial users who want stable inputs and will publicly talk down risk. Analysts who want a clean story and will keep repeating the substitution narrative because it is easy to defend. And the broader macro crowd that sees precious metals as gold and maybe silver, ignoring the industrial precious hybrids like palladium until the move is already advanced. That's the suppression. Not a secret cabal, but a collective comfort trade. And comfort trades break in the same way. The market doesn't ask permission. It just starts pricing the other side of the risk. Now bring in the 3 conflicts as accelerants, not causes. Taiwan Strait tension matters because it raises the global cost of trade friction. Even if the factories keep running, even if ships still move, the insurance premium rises, the strategic caution rises, and the reflex becomes secure supply sooner. The Korean Peninsula matters because it injects event risk into a region that sits inside critical manufacturing networks, and event risk doesn't need to happen to be priced. It just needs to be plausible when liquidity is thin. And the Arctic matters because it's not just ice and maps, it's security posture, it's strategic minerals, it's a public argument about control and access, and public arguments about control tend to produce policy shocks. Policy shocks are what make commodity curves jump. And when the world starts speaking in the language of security instead of efficiency, inventory stops being a balance sheet nuisance and becomes a strategic asset. That's the emotional core of this trade. The world is shifting from just-in-time to just-in-case, and palladium sits in the crosshairs because it's small, vital, and supply concentrated. But here's the part that keeps you from turning this into hype. This market can whip around violently even if the thesis is correct. Palladium is notorious for humiliating both bulls and bears. It can rip your face off on a Monday, give it all back by Thursday, and still be in an uptrend on the weekly. That's not a bug. That's how thin markets enforce discipline. They punish certainty. They punish leverage. They punish people who confuse noise with signal. So your job isn't to predict every tick. Your job is to identify what would confirm the thesis and what would invalidate it, and then watch the market's own lie detector interarm the structure to see which side is winning. The trend signal is this: holding above $1,800 and building acceptance, meaning pullbacks find buyers and price doesn't immediately collapse back into the prior range. The noise is intraday spikes, headline-driven jolts, and stop runs that don't change where the market settles. Now, proof stacking. Now, because one argument is never enough in a market like this. First proof point, the level itself. When a market reclaims a widely watched psychological level after being dismissed for months, it changes the incentive structure. Second proof point, institutional tone. Analysts have already shown a willingness to lift forecasts for platinum group metals after strong performance, and that matters because it changes how capital allocators talk about the space. It opens the door for rotation. Third proof point, supply stickiness and concentration. When supply is tied to a small number of regions and operational risk is real, the market doesn't need an actual disruption to price the possibility. Fourth proof point, the recycling hinge. If recycling ramp timing slips, the surplus narrative becomes a mirage, and the market will reprice the path, not just the destination. Fifth proof point, macro regime pressure. If the broader metals complex is being bid on inflation expectations, currency stress, or geopolitical risk, Palladium doesn't trade in isolation. It gets pulled by the gravity of the complex, even if its own story is unique. Sixth proof point, market structure reflexivity. Options positioning and dealer hedging can create forced buying when price climbs into key zones, particularly when liquidity is thin and shorts are leaning. Seventh proof point, and this one is subtle, behavior in physical markets and premiums. When buyers pay up, when availability conversations get tighter, when the "you can have it later" tone changes into "you can have it at a price," that's when the paper market starts chasing the physical reality. You don't need to see an official statistic the same day it happens. You see it in the way price reacts to dips. But the next detail is what flips the setup from interesting to actionable, the "why now" trigger. This isn't happening in a vacuum. The calendar is compressing decisions. The market is coming out of year-end positioning into a period where liquidity can be deceptive, where geopolitical headlines can land on weekends, where funds and desks are reestablishing risk, where roll windows and settlement cycles matter, and where a move through a major level forces people to rebalance whether they wanted to or not. That's why a rally can accelerate fast. It's not because everyone suddenly loves Palladium, it's because the cost of being wrong at the front end rises, and the curve will start to demand payment for time. If contango compresses, if nearby spreads firm, if the market begins to price immediacy, that's the tell. And if it doesn't, that's information too. Because if the curve stays comfortable, it suggests above ground stocks are still soothing the system, and the rally may need a new catalyst to sustain. That's the honest way to frame it. No magic. Just what is the market paying for? Now let's talk about the two scenarios for the next week or two, because if you're watching this, you don't want poetry. You want a roadmap. Scenario one is the controlled pullback and retest. Price pops above $800, runs hot into the mid to high on 1800s, and then it cools. That cooling is not bearish by default. In fact, it can be the healthiest thing because it lets the market check whether $800 is real support or just a momentary headline spike. In this scenario, the tell is whether dips toward the $800 neighborhood are bought quickly, whether the market settles above it, and whether volatility calms without collapsing the price. That's the market building a base on a new shelf. Scenario two is the continuation squeeze. That's when the market doesn't give you the polite retest. It keeps running, liquidity thins, shorts cover into rising offers, and the metal prints higher in a hurry because the market discovers there isn't much for sale at the front end at these levels. In that scenario, you get gap risk. You get the kind of move that makes people chase because they're afraid of missing it and then punishes them with a sharp shakeout and then keeps going anyway. The tell there is speed in settlement. If the market rallies and holds its gains into closes, if it doesn't immediately mean revert, if it starts printing higher lows even after spikes, that's continuation behavior. Now, the invalidation level concept matters here, and you don't need fake precision to use it. If Palladium decisively loses $1,800 and starts settling below it, not just wicking below, but actually accepting below, then the switch flips back the other way. That would suggest the breakout was premature, that the market isn't ready to reprice the regime, and that sellers still control the shelf. That doesn't mean game over forever. It means not yet. And not yet in Palladium can be brutal if you thought you had certainty. That's why you respect the level. Now, why bring geopolitics into a metal analysis without turning it into a doom show? Because geopolitics is not just fear, it's policy and friction. Taiwan Strait tension can change trade behavior even when nothing stops. The Korean Peninsula can inject event risk into supply chains even without a war. Arctic security debates can produce real investment shifts and real policy moves, especially when leaders talk publicly about ownership, security, and strategic access. And when policy becomes unpredictable, the value of holding the right inventory increases. Commodities are the ultimate real asset, not because they're romantic, but because they are the feedstock of the physical world. Palladium is a small corner of that world, which is exactly why it can move like this. But let's keep the tone finance credible. None of this is a guarantee of higher prices. It's an explanation of why the market can reprice faster than the narrative, and it's an explanation of where to look for confirmation instead of getting hypnotized by headlines. Watch the behavior around $800. Watch whether rallies are being sold immediately or held. Watch whether the market gives you deep dips or shallow dips. Watch how quickly bad news is absorbed. Watch whether the curve starts to reward immediacy. Watch whether the broader precious complex is bid, because when gold and platinum are strong, the whole sector gets a tailwind. And when they roll over hard, palladium often feels the suction. But there's one more thing you need, and it's the shield. Because the market will try to emotionally manipulate you, especially in a metal like this. It will do it with whiplash. It will do it with the "see, it's over" candle that shows up right after you finally believe. It will do it with the breakout candle that shows up right after you finally sell. It will do it with a weekend headline that makes you feel like you're late no matter what you do. That's how volatility extracts money from retail. It turns your attention into impulse. The antidote is not pretending volatility won't happen. The antidote is deciding in advance what you consider signal and what you consider noise. Signal is structural. Acceptance above a key level, shallow pullbacks, resilience into closes, a curve that tightens, evidence that the market is paying for time. Noise is emotional, intraday spikes, social media certainty, one-off headlines that don't change settlement behavior. If you can't separate those, palladium will eat you alive even if your long-term thesis is right. Now, what about the present $8,800 target itself? You were promised a concrete payoff, so here it is. Sudini teamed 100 is both a target and a trigger. It's a psychological magnet and a mechanical pivot. When palladium is below it, the narrative feels comfortable. Rallies will fail. When palladium is above it, the narrative gets forced to adapt. Maybe the metal isn't as dead as we said. And adaptation is where money gets made, because adaptation happens under stress. If price holds above $800, you have a plausible path for the market to challenge the recent highs in the upper $800 again. And if that area breaks cleanly, the next phase becomes a search for where supply actually shows up. That's the honest version of explode. It's not a prophecy, it's a mechanism. Break resistance, trigger forced buying, invite new buyers who were waiting for confirmation, and stress the shorts who were leaning on the old range. But if when $800 fails and the market accepts back below, the setup turns into a different game, a volatile range where patience beats excitement and where the metal can still be bullish longer term but punishes anyone who confuses a headline spike with a regime shift. That's why the level matters. It tells you which game you're playing. Now we zoom out for the institutional angle, because retail investors underestimate how much capital moves on relative value, not absolute love. When gold runs hard and gets expensive, capital starts hunting for the next place to be within metals. Platinum group metals can become that rotation candidate, especially when analysts start raising forecasts and talking about tight supply. It doesn't take a massive ETF stampede to move palladium. It just takes marginal capital deciding the asymmetry is attractive. Because palladium is small enough that incremental flows can matter, and that's also why it's dangerous. Small markets don't forgive crowded positioning on either side, which brings us to the last practical thing, what to watch next week like a pro, not like a tourist. Watch how price behaves around $800 and the mid-1700s highs as the line in the sand zone if we get a deeper pullback. Watch whether rallies are accepted or rejected at the high 1800s area. Watch volatility. If we get sharp sell-offs that are bought back quickly, that's strength. If sell-offs cascade and rebounds fail, that's weakness. Watch macro. The dollar, real yields, and risk-off waves can temporarily overpower metal-specific stories. Watch the news cadence in those three conflict zones, not for your emotional reaction, but for whether it changes market behavior, especially into closes and after weekends. Watch the curve and nearby spreads like a heartbeat monitor. Because if immediacy starts to get priced, the market is telling you tightness is no longer theoretical. And watch the recycling narrative with skepticism. If the entire surplus story rests on recycling ramp timing, then any sign that the ramp is slower, more expensive, or more logistically constrained than projected matters far more than 1,000 hot takes. That's the hidden detail that reframes everything. Palladium can look like a future surplus on paper and still behave like a near-term shortage in the real world because the timeline is the trade, and timelines are where squeezes are born. So here's the subtle CTA, and it's not begging. If you're the kind of investor who'd rather understand mechanisms than worship narratives, stay with this corner of the market. Not because it's easy, but because it's honest. The crowd will chase after the move is mature. The institutions will talk their book. The headlines will arrive late. Your edge is watching what the market is forcing participants to do before they admit it. And right now, Palladium is forcing a conversation around $1,800 that most people aren't ready for.